Welcome everyone to the second day of the Asia Risk 25th Anniversary Week. We're now well into the full week of forward-looking webinars covering major themes like investment, LIBOR transition, technology's role in the current environment, regional countries and responses to the pandemic, and last but not least, next generation risk management and strategies. Besides the insightful panel discussions, we will continue to be announcing some of our award winners and featuring some interviews with those winners, which highlight the innovation and effective strategies our winners have managed to showcase this year. Starting off today, we will be focusing on market infrastructure. Our Bureau Chief Asia from Risk.net, Blake Evans-Pritchard, is with us here again today. Hi, Blake.
Hi, Steve.
So, Blake, great start yesterday and a continuing busy week ahead with lots of award winners to be announced. What can we expect from today?
Well, coming up, we have besides more awards announcements, we have a very interesting discussion on LIBOR transition, which is a fascinating topic, arguably the most important financial transformation going on at the moment as people scramble to get ready for what the end of LIBOR at the end of next year is going to mean. And particularly interesting to look at how things are developing in Asia. And at Asia Risk, we've been looking a lot at this, and people are in very different stages of readiness. And there are certain warning signs that people, particularly sort of smaller organizations and on the buy side, are not going to be ready in time, and they don't really know what to do. So it'll be interesting to hear the panel discussion later.
Looking forward to that later on. Thanks for joining us again today, Blake. Stay tuned. If you're like me, you're looking forward to the panel discussion, award winner announcements, and some interviews with a selection of winners afterwards. Have a great day. Welcome to the LIBOR Transition panel discussion. Glad you could be with us. With the uncertainty around the future of LIBOR post-2021, the Asian markets have been lagging behind in the transition progress, which is causing uncertainties in financial institutions, especially with the unprecedented event of the pandemic and the global economic disruption. Today in our session, we've invited leading experts in benchmark reform to discuss and share their thoughts on where we are in terms of the transition and alternative rates, and how firms can map their next steps ahead. Our panelists today include Alex Bond, Group Co-Head, LIBOR and Benchmark Reform, Murex; John Henson, LIBOR Transition Lead, CIB Regulatory and Risk Delivery, National Australia Bank; Ravi Pandit, hi John, Executive Director, Interest Rate and FX Products, CME Group; and Paul Wiley, Head of Risk Asia Pacific, LCH. Welcome everyone. Before we start, I'd like to remind our audience that all of the sharing from our speakers today will be from their personal perspectives and experiences and not necessarily represent their company's stance. Additionally, this panel was recorded on August 31st, and with the rapidly shifting sands of LIBOR, there may have been announcements made since the time of this recording. We still invite you to direct any questions you may have to our panelists, and we will do our level best to get those answered and back to you in a timely fashion. There is much to discuss with LIBOR transition panelists, and I know you could all speak to all three of the themes we've decided to speak to today, so let's get right to it. I'd like to invite John Henson to kick things off, speaking to our first thing, LIBOR transition, John, in the Asia Pacific. John, what are the current challenges, latest updates, and the next steps to take?
Thanks, Steve. Certainly been an interesting year with COVID and the impact of COVID across the various markets. And we'll come back to that a little bit later in the conversation. But I think one of the key call-outs that I'd like to make is that globally we all are facing into similar timelines and deadlines on this transition of LIBOR to RFRs. The FCA has been out and about fairly recently, once again talking about the dates and reaffirming that notwithstanding COVID and the impacts of COVID, the timeline for the end of LIBOR or beyond 2021 is something we all need to be working towards. So I think that's an important call out to say. So there are certain areas in the world jurisdictionally that may be tracking slightly ahead of the game, but generally all the regulatory responses that we've had to respond to all have a similar theme. How are we positioned to meet that end of 2021 date, and how are we prepared to transition off LIBOR into RFRs from an organizational industry perspective and importantly for our customers. So leading into that, I'd like to take a little bit of a forward view on things. There's been fantastic work done globally across the various working groups. And if you've stayed closely aligned to the outcomes of those working groups, you'll know pretty much what they are recommending. So the important things that I would be looking towards in the next quarter, at least, is the protocol. We've spoken about the protocol and the importance of the protocol. We believe it's imminent sometime in September, maybe out by the time this recording is played out at the conference. Regulators are urging everyone, buy and sell side, to actually adhere to the protocol. The discount shift in October to SOFR is another very important milestone. Liquidity in the US SOFR benchmark is still very low, and the SOFR switch is being earmarked as one of those things that will catalyze liquidity growth in SOFR. Importantly, working groups have also established across the various jurisdictions some timelines which they've suggested we should be adhering to, or trying as best as possible to adhere to. So please look at those and see how you can actually position your organization to meet those timelines. I think that's an important point of focus over the next 4 months. Your activities to transition is absolutely key. When we talk about the impact of COVID, in some respects, it's allowed more time for preparation for what is a very challenging transition. So whilst it hasn't been great for economically for everyone, it certainly allowed some time for organizations to prepare deeper into the transition and the activities that are required to transition from LIBOR to RFRs. And then lastly, make sure you are reaching out to your customers, engaging with customers, and understanding their readiness for transition. Transition is complex and it's multifaceted, and there's so many things that you need to be across in order to take your customer through a transition. And yeah, those would be the things that I'd be focusing on over the next 4 months.
Great, thanks, John. Ravi, what do you think?
Yeah, so from our perspective, we are pretty close to the US dollar LIBOR transition process at CME. We've been involved with this process from an very early stage. And incidentally, we were the first to launch derivatives linked to this brand new alternative rate very soon after it was published in 2018. And we feel that the importance of US dollar LIBOR transition in the APAC region is going to be paramount, because just purely because US dollar plays such an important role, not just as a funding currency in the region, but also the rates, local currency rates are highly correlated with the US dollar in certain cases. So I think a lot of our APAC clients are closely following the development of SOFR, and we are focusing on educating them about the SOFR futures, which we launched, as I mentioned, in 2018. And we saw a little bit of slow uptake in Asia last year, but I think this year we're seeing much more of acceleration in people wanting to voluntarily adopt the new rate. Purely because, in some cases, because the central banks are now, writing to the various financial institutions, the Dear CEO type letters, even in Asia Pacific. So I think some of them that has spurred the increasing interest in SOFR adoption. So the other area we are working on, besides educating people about the SOFR rate itself and the underlying derivatives, is on CME's own transition plans. So Eurodollar futures and Eurodollar options are the two products which are linked to LIBOR. And we've published our transition plans with regards to these, which are the plans are closely aligned with ISDA, with obviously some differences which suit the products themselves. And in both cases, they are involving substitution of the underlying product with a related SOFR product with a SOFR future. And more details of this are available on our website. But because the transition involves switching from LIBOR-based contract to a SOFR-based contract, it's very important that people in the region are well educated on the rate, how it behaves, what are the underlying factors, and obviously the processes as well. So CME is also closely involved with the discounting transition switch, which is going to happen on October 16th. And we feel that will also spark activity in the OTC market. So that should be a positive from that perspective.
Thanks, Ravi. Paul, what's your take on all of this?
Thanks, Steve. Look, I just reinforce what's been said already. I think that's the really important points from Ravi and John there. I would also say that perhaps what we haven't touched on is that this is a wider issue than just derivatives. So it affects all income markets, it affects bonds, loans, it affects everything. So it's a huge, huge change. Saying that from LCH's perspective, because we act we're a CCP in the derivative space, and that's what we do. And I'll just touch on the points that are probably relevant from our perspective. So the current challenges really for us is the adoption of those new fallback rates that were mentioned previously. They're kind of key or the next key thing that needs to happen, and we need to apply them obviously to ISDA contracts and bilateral contracts, but also into our rule book. The second thing is for the adoption of all these new risk-free rates as and when they come about, to adopt them as the new discount rate. And we're in various places around that. As Ravi said, across all the CCPs, we are consistently shifting from Fed funds to SOFR for US dollars, and that's coming up in October. I think from the perspective of LCH, really the next steps or the big challenges going ahead from here, as opposed to the current challenges, it's really to build out the liquidity in these new RFRs. And liquidity is still very much in the legacy rates and legacy LIBOR rates around the world. And it's a real challenge to shift that inertia from people trading what they're used to and what they know, and certainly where a lot of liquidity still remains, into those new risk-free rates. And that's a challenge for market players, it's a challenge for us, and it's a challenge for regulators as well. And the second challenge, or the second major step I think we need to think about in 2021 is to reduce or switch the outstanding notional or the outstanding positions in LIBOR contracts. We don't want to wait. As I like to say, is that LCH is the biggest user of LIBOR in the world, but we don't actually have a position being a clearinghouse. So we're net flat, but we've got the biggest outstanding notional for LIBOR. And with that, we certainly do not want to wait. We don't want our clients or our counterparties to wait, and we want to get this LIBOR notional down to a manageable level if or when a benchmark fails.
Great. Okay, thanks, Paul. Gosh, lots to talk about. Ravi, let's shift our focus now to the different stages of development of local alternative risk-free rates and accessing the liquidity issues. What are your thoughts on this area?
So once again, I would draw your attention to what we have seen in the US dollar space, because obviously that is it's a brand new rate, which didn't exist before 2018. And it's pretty much starting from zero. So in several cases in the APAC region, which are starting with new rates, you'll probably see similar trajectories, if I may say that. But with one caveat, in the case of the US dollar SOFR, we have already seen vibrancy in our SOFR futures. It is to be seen whether there'll be listed derivatives in the APAC region for the APAC underlyings. But speaking about SOFR, from zero volume in 2018, we've seen volume grow to about 50,000 lots roughly a day. And the increase has been steady, with obviously sharp upticks on days in which the underlying repo rate has been active. So because SOFR has got underlying as the overnight treasury repo rate, it is directly linked to activity in the repo market, and it tends to be more traded when the repo rate is volatile. So at CME, what we have done to grow the liquidity, from our experience with similar products in the past, is, firstly, we've tried to use our strength in our core products like Euro-dollar futures and Fed fund futures, and use like relative value spread trades between these products and the SOFR futures to grow the liquidity in the SOFR futures themselves. And this is because these spreads are very naturally traded in the OTC market as well. So people do trade Fed fund versus SOFR and LIBOR versus SOFR. And, it's LIBOR versus SOFR is a proxy for LIBOR versus OIS, for example. And so these relative value types of trades, which can at times account for close to 50% of the daily volume, these play a very important role in shaping the liquidity in the underlying contracts. And other than that, it's just educating the clients about how these products can be used. So they provide a very natural repo hedge to anyone involved with repo trading in US Treasuries. And you know the amount of dollar reserves in Asia and the amount of dollar treasury holdings in Asia. It's a huge holding and huge market. And at some stage, people will be interested in knowing how they can hedge the repo, especially term repo, using these futures. So relative value trading, repo hedging, and then there's a natural growth, as more and more people voluntarily adopt this rate. So as people start trading the product, they see opportunities in it. Once the cash markets and the OTC markets develop, so currently the cash market from, let's say, October 2018 till last month, only around $900 billion total had been issued, roughly. Which is quite small if you look at how much was issued in other underlying indices, etc. So, and for the cash market to grow, you need a vibrant underlying OTC derivative market, which will probably happen after the discounting switch in October. It will be accelerated by that discounting switch. So I think all these three markets, the listed futures, the OTC derivatives, and the cash market, will probably see a spike up, post the discounting switch and in the lead up to the end of 2021.
Great. Thanks, Ravi. Paul, I think we can get you to chime in on this one.
Yeah, sure. Look, I think the experience across Asia, or where various countries are across Asia, is mixed. Some are very advanced, and some had a ready-made, so to speak, RFR in place already, like Australia and New Zealand. And so there really wasn't that much change there, and there's been significant or good adoption in those particular countries. But across, I guess the rest of Asia, it is mixed. I'd probably certainly like to call out Singapore, which I think is probably a great example of what can actually happen. And I have to give them a lot of credit because the regulator got the whole industry together, including the LCH, because clearing is a key thing for building liquidity within a new risk-free rate. But they got the whole industry together to ensure that the RFR worked, that the RFR was one that the industry could use, or that the market could use, and that from day one that it was going to be a success. And so they've been really driving and pushing that RFR to be a success. I think in other jurisdictions within Asia, certainly it's been a more passive approach, but we've seen a variety of approaches across the region. And I'd probably just make one last comment. That is still, as I said before, there's a lot of inertia, and that inertia is probably driving a lower take-up of RFRs across Asia as opposed to Europe and the US.
Okay. Alex Bond, we haven't forgotten about you. Would you like to chime in on this one?
Thanks, Steve. Actually, yeah, I think Ravi is absolutely right to emphasize the importance of the transition from US dollar LIBOR to SOFR for any firm active in financial markets in Asia. And Paul is absolutely right as well to point the diversity challenge and the fact that we are dealing with a multiplicity of economies and jurisdiction with different development stages and different local benchmarks. And personally, when I'm trying to look at the LIBOR transition issue for the region, I feel like it's looking through a kaleidoscope. We often say that this LIBOR transition process is a market-led process. I'd say it's a markets-led process, and in Asia we have many markets, and that is a source of complexity. So if you try to analyze the situation, on the one hand you'll have jurisdictions which are already quite advanced in defining their alternative reference rate and working on basically developing trading and liquidity on those new benchmarks. And that's typically the cases of the more advanced economies with fairly developed financial and derivatives markets. So at the top of those, you'll have Japan, which is what we call a multi-rate jurisdictions. So they are directly impacted by JPY LIBOR being discontinued, but they also have other IBOR benchmark index like JPY TIBOR, for instance, which will carry on for a period of time unknown at this stage. So that gives them an interesting situation because they have created identified TONA as their alternative reference rate. So it's an OIS rate, and that's the one that they are trying to develop. And that is the selected fallback reference rate for both cash and derivatives product. But some firms may want to use instead this JPY TIBOR, for instance, when they are devising custom fallback arrangement for instance, for exotic derivatives, where they feel an OIS rate would not work as a fallback mechanism. And Japan is probably the most advanced because they also are prototyping now a term version of their TONA index, which they are calling TOF. That's the Tokyo term rate, term risk-free rate, I think. And that is viewed by some segment in the market as a very positive thing to have, because some corporates in particular would struggle operationally with moving to alternative reference rate, daily OIS compounded in arrears. So having a term rate is seen as quite an interesting option. Then you have Australia, which is also quite well advanced, and John covered that. We have here some good progress in adoption on the AONIA and cash rate. I mean, obviously, we are seeing there the adoption challenges that both John and Paul have highlighted, but a lot of efforts are being put by market players there, and we're seeing some progress, so it's quite encouraging. Then we have Hong Kong, which is in a similar situation, but in their case, they have created an entirely new OIS index called ONIA as their new alternative reference rate for local markets. We are seeing here very good support and actions from HKMA to develop and help their institutions work on the transition. But there is no end in sight for the local LIBOR, which is HIBOR. And ONIA is a completely new beast for the local market. So that means that the adoption rate is still slow there. And most of the focus is on working on the transition on US dollar LIBOR. Now, at the very other end of the spectrum, you'll have places where alternative reference rates to the local LIBOR have not been identified. So for instance, in Korea, now they have a task force which is working on the topic and will probably announce alternative reference rate by late 2021, most likely to be also a secured rate, OIS rate. And then you have places like maybe Malaysia or the Philippines where we have no news on this. And it's true that for many of the local economies which never had a local OIS index, it's not an easy thing to create this kind of new benchmark and for institutions to get used to using them. Now, what I think is the most interesting case is the case of the jurisdictions where the local IBOR is actually a synthetic FX implied rate that is derived from US dollar LIBOR. And that is the case of Singapore with SOL, of the case of Thailand with THB6. That's the case of India with MIFOR, and that's the case of the Philippines with FIREF. So I won't go into details of the mechanics, but basically for those countries, the day the US dollar LIBOR is switched off, their local index dies. So Paul explained very well that Singapore, I think, is the most advanced of those countries in their transition process. They have launched SORA as their local alternative reference rate, and clarified about 10 months ago the fallback mechanism to a mechanism that we called adjusted SOR. So basically, you'll have a kind of synthetic index created off SOFR. So just like US dollar LIBOR derivatives will fall back to SOFR rate daily compounded in arrears, then we'll use that and apply an FX adjustment on top of this to deal with those legacy positions referencing SOL. So there is a very strong push in the local market to develop liquidity. MAS is helping, ABS is doing a great job as well. So we are seeing some very good progress. LCH, I think, cleared the first SORA interest rate swap back in May. A little earlier than that, we had OCBC and Standard Chartered transacting and cleared interest rate swap on SORA. DBS has issued an FRN on SORA, and then the MAS just announced the issuance of a major FRN on their side as well. And they are actively encouraging the issuance of those bonds and trading of those bonds by the local banks. Now, one thing that happened, which was a bit of a surprise move, is that a couple of weeks back, they opened a consultation where they announced that they will as well discontinue SIBOR. And SIBOR was the other local IBOR rate, which is used more on the cash retail market. And until now, the plan was that it would be reformed and would be allowed to carry on, like, for instance, JPY TIBOR in Japan or BBSW in Australia. So this is interesting because this is really the first multi-rate jurisdiction to announce a switch to a single rate approach. And that's really to help develop this liquidity in SORA. As well as kind of removing any term rate alternative option, as we are seeing that most likely they won't be ready to develop a term version of SORA in time for the deadline. Now, if we move on to Thailand, Thailand is quite an interesting case because they face a very challenging situation. About a year ago, there was very low awareness in the market about the LIBOR transition, but Bank of Thailand has done quite an impressive job engaging all market participants and being very approachable. I mean, we actually had contact with them on technical issues quite a few times. And so they created a new, entirely new alternative reference rate, THOR, that started publishing in April. And then this summer, they finally crystallized the conventions for trading new products on THOR, as well as ironed out all the final details, technical details in the fallback mechanism to the adjusted THOR mechanism, so similar to Singapore there, which is now quite well aligned with what Singapore is going to do. And what I find quite impressive is that while all this happened during this summer, we have had today the very first interest rate swap transacted on THOR between two Emirates customers. And that's actually quite an achievement, because that means that in about a month, those institutions had to be able to transact a new OIS index on swap for the first time in Thailand. They had to go through the model validation, they had to adapt the systems, get all their processes in place. So we are seeing really very good progress and encouraging progress there. Now the challenge is difficult because I mean this kind of adjusted index mechanism also creates some additional complexity in terms of risk projections and analysis, but it's quite encouraging. Now, finally, you have India, which faces a similar situation with MI4. We were initially expecting some news in September, but the IBA, so the Indian Bank Association, has announced they will postpone the decision around the fallback mechanism till December. They're very likely to follow a similar approach to Singapore and Thailand, but there's still an open question as whether they need to create a new local RFR index or try to simplify trading in cross-currency swaps for their institutions. And then Philippines has no, we don't really have visibility on what's happening there. So for those institutions, for those jurisdictions, I think it's a very interesting case. A lot of complexity for those markets, which have to deal with both US dollar LIBOR going away and the local index being impacted with very little time left. I mean, to me, the deadlines are insanely tight, but we are seeing very good progress, and that really is encouraging.
Thanks, Alex. I'm going to let you catch your breath there for a second, but I'm going to throw the next theme at you. Thinking about LIBOR transition, IT systems, operations, implications, and how to handle this challenge. Where are we in this? And maybe grab a drink of water if you're ready to dive right in. We'll just do on this one, and then we'll over to John too, if we could. But go ahead, Alex.
All right. So I think, I mean, obviously, I'm coming from the system provider angle. So to me, it's a massive issue. One which has been relatively under-discussed, I think, in the market, aside from a couple of narrow points. And still, I'm coming from a relatively narrower angle. I mean, at Murex, we're a provider of solutions for capital markets. We focus primarily on derivatives, but there are a lot of things, other business processes which are happening outside of Murex, which are also impacted. Now, why is there so much to do in the space of systems? First of all, institutions need to tackle different types of issues impacting both their operations and the system. The first one is they need to be able to support the new RFRs. So they need to overhaul their system to be able to support this kind of new conventions in area compounding, new curve modeling questions for those new indices, potentially some pricing and modeling questions quite difficult for derivatives. And you also have potentially a performance impact questions, because switching from your traditional LIBOR swap, which fixes one rate per period, and replacing that with a SOFR compounded swap, where basically you observe the SOFR rate every single day and compound it to the end of the period. Obviously, you have more operations from a system point of view. So you should expect some kind of performance impact there. That's an area where at Murex we've been working on, so we'll be presenting some optimization to our clients later this month. And I know this is an area where we've been exchanging a fair bit with LCH also. But that's one part, supporting the new RFR. We've heard about it, especially for loan system. I would contend that is actually the easy part. The second point that institutions have to deal with is having a good understanding and keeping an eye on their LIBOR exposure. Where are all the dependencies? How are they progressing in their remediation program? And I read this summer, there was an analysis published by a consulting firm, SIA Partners, where they did a survey of institutions in Asia. And they highlighted that in Asia, only 8% of the firms have actually completed their risk identification and assessment analysis. So there's still obviously quite a lot to do then. You need to get the big picture, but also as you're starting to implement your transitioning strategy, negotiating with different customers, you need to be able to run this kind of analysis and what if scenarios in each case. And finally, the most important part is the impact of all the transition events. So we talked about the discounting switch and the change of collateral rate and how it's going to impact valuation and operations, both for the cleared side first and then the uncleared side. Then you have active transition, where you're basically going to work with your customers ahead of the deadline to try to transfer your position to another index. And then there is the actual case of a cessation or pre-cessation trigger and the execution of fallback mechanism, whereby you need to automate this contract transformation in very high volume. And that means including all the specific adjustments that you'll have for broken period, treatment for these FX implied indices. And this applies for your standard industry fallback that like the one specified in the ISDA supplement and protocol, which are going to come out soon, but also custom fallbacks, because we know that there will be custom arrangements out there in the market. So from a system point of view, you need to be able to track which one goes there, automate this on a very high scale, and make sure that all business processes in the firm has impacted correctly. That means streamlining the impact through all the departments, explaining the P&L jump that you're going to see, being able to do your P&L jump, explaining the differences in XVA, explaining the difference in initial margin calls that you'll experience on the day where you do that transition, being able to run your P&L and your risk as of a past date with the earlier definition of the trade when you're comparing it to today. It has impact on accounting, on settlements, on confirmations, on the whole life cycle of your transactions. You need to properly audit. You have the question of downstream documentation and reporting requirements, because you'll have some relief, at least in some jurisdiction, regarding taxation or accounting or initial margin, but you need to be properly justify that a new trade is eligible to that relief because it was part of a LIBOR transition process. And all this needs to be scalable and performant from a technical point of view. So that's a very important point. So you are touching every thing you can imagine in a financial institution. So all systems that are processing those trades or touching those trades directly or indirectly are impacted. And if you're wondering, I think there is, for institutions which are starting to work on this analysis, there's a good starting point, which is the document that the ARC published this July, which is called the ARC Internal Systems Process Transition Aid, which are listing all the transition processes, all the business processes that they think are impacted. It's about 50 pages long, and it just scratches the surface, but it's a good point to start from. And if I tell you at Murex, on the small portion of all those business processes, we have actually started writing down a document with user stories, so listing down all the processes, all the mechanics that are impacted, so that we can present to our customers how they can adapt and adjust the Murex system to deal with those. And today we have 194 user stories just for the derivative space. So that's quite challenging. And I think the last point, which is a huge challenge for many institutions, is that contrary to your, I'd say, previous big regulatory development where you know from the start what it is that you are building and you know the deadline, here you have to deal with continuous evolution, continuous changes. I told you, okay, the details of the ISDA fallbacks, the fine little details, and especially the FX implied indices, that was only clarified this summer. But we are, I mean, the swaption compensation mechanism, the market learned that there will be a new field in market wire in March, and the first deadline was initially May, and it was pushed to June for the Esther discontinuation change. So that's very difficult to manage from an IT program management. You can't run your classical waterfall program where you have your specs, your development teams go and disappear for 1 year and come back, and then you've got 6 months to test and put it in production. So that's actually why I think it's such a big issue. The silver lining is that with this type of change, any kind of big market change, I also believe that you have some real business opportunities. And I don't mean that only for the creative little hedge funds will come up with a cute trade. For banks, there are real business opportunities, and there is a competitive advantage to being ready early. So.
Thanks, Alex. John, all of that and COVID-19 pandemic, what are your thoughts?
Well, Alex has provided a very comprehensive view around the challenges. I mean, the one thing Alex didn't pick up on as well, but Alex, I'll leave you more technical. In amongst all of that, we've got to get all our legal agreements renegotiated as well. So, you know, you've got to gather your legal contracts from loans, floating rate instruments, and have a look at it and see what needs to be changed and adjusted whilst doing all the changes that Alex has provided. There's some little complications on conventions. We're rewriting 50 years of inbuilt pricing mechanisms in legacy systems. We're busy rewriting it again in our current systems, and some of our current systems are older systems. And that is difficult. And each jurisdiction seems to have a little bit of a flavor, I call it a little bit of a different flavor on what they are moving towards. You know, look back, observation shift, simple compounding versus compounding. You know, you've got to understand all those nitty-gritty details in your development of your systems. And if you're dealing with, you know, with systems and change, generally they like it in a requirement. And when you say, well, just, you know, can you do all the conventions and try and cater for all, knowing that you're likely to standardize in, you know, maybe one or two or three of them in the future, we just don't know. So you have widened out quite a bit of the work and that needs to be done. Fortunately, I think it's improving and people getting on top of that. But the internal work across organizations will each have a unique story to their organization about what they're going to have to do in terms of their technology that might need to be changed. But then the process of transition, move of a customer from one, sounds simple, from one rate to another rate, requires people to do it as well. So the impact on your processes and the impact on people to do the actual transition is an important consideration. And given that we seem to be, you know, pushing it all into 2021, means that that's all being compressed into a shorter time frame. So it's going to be a very interesting 2021 as we look to do all the things we're looking to do, and, you know, move not only derivatives, but you've also got your lending products, your other cash products, consensus stations, perhaps. And then, of course, you've got your other things that have popped up called tough legacy, you know, those that are just going to be too hard. It's going to be in that too hard bucket. And there's legislation that's been promulgated in the UK and US to try and deal with those tough legacies level that you just won't be able to do and transition. So what can I say about 2021? It's going to be tough. There's certain segments of the market that have economically been more impacted by COVID. So my view is talk to your customers, understand how they position. If we look on the sell side firms, we've got projects up and running and we challenge internally to upgrade our systems to meet the new requirements of these risk-free rates and the transition processes. How are your customers progressing as well? Because the timing of that transition is really going to be reliant on your customers' preparedness to do the transition. You know, it's not something that you can just, you know, say, well, we're going to transition you today. There's a lot of complexity in that transition. There's contracts, there's pricing, there's all a number of components that you'd have to discuss with your customer before you can actually do it. So, yeah, it's an interesting proposition for 2021. Tighten your seatbelt.
Yeah, no kidding. All right, guys, I think we could talk until 2021, but unfortunately we're coming to a close of the panel. Thanks very much for all of your insightful comments and remarks. And what I'd like to do is offer you an opportunity to give a one-line takeaway from the speakers. How do you see the LIBOR transitioning progress? And are we up? Are we up for it? Are we falling behind? If so, what can we do to catch up? And we'll start with you, Paul. What do you think? If you could look into a crystal ball, what do you see?
Look, I think, you know, hopefully what's come out of this session is that there is lots and lots of work to do in this space. And in 50 minutes or an hour, we can't do it justice. So the key message is that you need to be starting to prepare now. You can't leave this to 2021. You can't certainly leave it to the second half of 2021. You need to start preparing now.
Great. Okay, thanks, Paul. Ravi.
Yeah, so I think we will see acceleration in the pace of adoption going forward. But what's key is also for the people to understand the new rates they're dealing with, and that's where once again in the US they have historical data, I think until 2014 for software itself, and then there's a proxy data before that. So data is going to be key in understanding how the new rate will behave. So besides the technical aspects and the legal aspects, just understanding the rate and how to use it, etc., would be the key in the transition process as well. That plus comfort in the transition process itself. Mm-hmm. So whenever we explain the CME's plans for the LIBOR transition, most of the clients say, "Oh, that's great. That's quite straightforward. It's, from an operational as well as from a risk perspective." So being comfortable with the transition process is also key.
Great. Okay, thanks, Ravi. Alex.
Yeah, I think we've all emphasized that it was a big undertaking, and you should not underestimate the challenge, and you need to start early and leave no stone unturned. I'd say maybe two little pieces of advice in tackling the problem. One is, do not mistake the tree for the forest by only focusing on the immediate next challenge or the immediate next milestone and its challenges. The second is, by all means, reach out today to your infrastructure providers and to your business partners to understand their views, to understand their needs for that transition. Will they sign the ISDA protocol? When do they plan to repaper their CSAs? Will they negotiate for a compensation for the discounting switch impact? Do they intend to transition their derivatives book early? Only when you get that clear picture of all the variation, option, and complexity that you're facing, and as well the new business opportunities, you can really prepare adequately for it. There was that, I sound a bit pedantic, but there is a little phrase from Seneca who said, there's no favorable wind for the sailor who doesn't know where he goes. I think that really applies here.
Fantastic. All right, we'll send it over to the last sailor. John, you've got the last word here.
Thank you. So having been on this journey for a while, one thing that is starting to become very apparent is the key mechanisms that we've been waiting for are now starting to be in play. We had the ISB relief come out, the phase 2 relief this weekend. We're waiting for ISDA. We got the SOFA switch in October. Potentially the FCA might even come out as an announcement at the end of the year. All of these things possibly have been things we could have looked at and said, well, they're not there yet. So we could delay. They're all becoming there and available to be used. The information from working groups, the amount of work that's been done and the amount of work that's available to people now, absolutely embrace it, take it. And I think Paul said, you can't wait. You have to start now and keep preparing because you don't know what's going to occur in 2021. It's going to be a challenging year to transition.
John, Alex, Ravi, and Paul, thank you very much to all of you today. It was a very insightful discussion. I'm tripping over my words because I've got so much to think about. And I hope our audience will have lots to take home too. I know they will. And we invite you in the audience to please submit any questions you have, remembering that we've pre-recorded this seminar on August 31st. Thanks so much for tuning in. On with the show. Clearinghouse of the Year, LCH. Clearing Bank of the Year, BNP Paribas. Securities House of the Year, Haitong International. Derivatives Exchange of the Year, Hong Kong Exchanges and Clearing Limited, HKEX. Collateral Manager of the Year, JP Morgan. Custodian of the Year, BNP Paribas. Market Maker of the Year, Deutsche Bank. Securities Lender of the Year, JP Morgan.
On behalf of LCH, I'm delighted to accept Asia Risk's CCP of the Year award.
2020 has been a fantastic year for LCH in Asia, and we're looking forward to 2021, where we've got even more planned.
And of course, this award wouldn't have been possible without the amazing support of our members and clients. Thank you, and we look forward to working with you in 2021.
こんにちは。LCH 日本代表、今西です。この度はアジアリスクの CCP of the Year をいただき、大変光栄です。これもひとえに生産会員、並びにクライアントの皆様のおかげだと感謝いたします。LCH は日本におきましても、マーケットのパートナーとなり続けるよう努力をいたしますので、今後ともよろしくお願いいたします。